Oh, it's amazing.
What?
Never mind.
Okay. So the labor efficiency variance, did you guys get 105,000 unfavorable? Okay, good. So what was the trick to that piece? Yeah, well, not not standard hours. I gave you standard hours, did I not?
No.
Yes, I did. I said each.
Oh, not as a whole, though.
No.
You
We
still
still
have
have
to
to calculate how many
budget
hours, so.
Oh, sorry. I guess the 250, oh, this isn't worded very well, is it? Okay, should take. So the standard there was the 250. Sorry, you know you guys can talk to me when we're having an open book test, right?
Just figure it out.
So the standard there was 2.5 hours to manufacture, and they actually took 3.5. But if you did it backwards, that's okay. Just in a question, see, and this is the perfect example. If I do this to you on the exam, then what I would do as a student, if you're too chicken to call me over, which you probably should, because if you're confused by that question, it's probable everybody's confused. It's like, well, you're not clear which one is the standard. Okay, so now I would write on the board, 2.5 hours is the standard. But then I would write, assume the standard estimate is 2.5 hours and the actual is 3.5. And then I know when you go on later to do your stuff, if your answer is different from mine, that those are the assumptions that you made because my question wasn't clear. Okay? So you needed to figure out the rate, yes, because I was unclear. But because the budgeted labor rate, we're talking about the labor rate, is $21 per hour, right? But you didn't know how many units that they made, right? So you had to figure that out. So everybody should have got 5,000, right? So did anybody not get 105,000? No? Okay, we're good. So then the next question was the labor efficiency variance. Oh, that's 105. I jumped one. Okay, the next part was the total flexible budget labor variance. So what did you guys do there? You just add them up, right? So you should have got 52.5 unfavorable, right? Because we had 52.5 favorable, 105 unfavorable. Perfect. Okay, so number 5. I want every one of you guys to give me some explanation for a variance. So I wanted to know a reasonable explanation for the variances you calculated and how you might correct it. So what's one explanation that you might have for this combination of variances?
Well, look, the salaries are lower and the productivity is lower, which suggests an unskilled workforce. And so more earnings equals.
Right, exactly. So let's say that instead of those two variances, you had got a variance where both the labor rate and the efficiency variances were favorable. What's an explanation for that? So let's say you got a favorable labor rate variance. So what does that actually mean if it's favorable? You paid more or less for your workers? Less. So your workers were paid less. If your workers are paid less than your standard, then you get, that gives you a favorable labor rate variance, right? Okay. So what are some reasons that your workers might be paid less, other than they're less skilled? What are some other reasons why your workers might be paid less?
Work less hours.
Well, working less hours won't actually affect the variance,
Oh, right.
because then you just need more. So, good thinking, but that won't actually affect the variance. So,
Is
Maybe
it
we need
that
to
higher?
use the rate.
Pardon?
Maybe when you choose a reason or different.
Yeah, maybe they're underpaid.
Yeah.
Yeah. So maybe they're underpaid. Can you think of any other reasons? How about maybe they received a government grant that offsets the wage expense, that pays a certain amount per hour. You know, sometimes they have work incentive programs, right? And the government gives you a grant. And so you would actually you would be paying your workers less because the government is paying the other piece, right? So that's another reason why you might have a favorable labor rate variance. So,
So you're saying any type of sponsor or
yeah, well, what do you mean by sponsor?
like, or donations or no?
Well, people don't usually give donations for paid skilled labor, right? Can you think of, like, what are you thinking of?
Because I'm thinking of other than like more like a general idea than government grant.
Well, think business though. Like how likely is it somebody's gonna donate money for you to pay your workers? I mean, for a non-profit organization, but probably those people are very, volunteers, but I see where you're going. Okay, so what about if you had a favorable labor efficiency variance? What are some things that might give you that? So if you have a favorable labor efficiency variance, that means what? In regards to, so the rate variance is that. So the efficiency variance measures what? What does it measure?
Efficiency.
It measures how much time you use. So it's measuring the hours against the standard rate. Okay? So the labor efficiency variance is measuring how many hours you used. So favorable labor efficiency variance,
So your workers were very productive.
they were faster than you expected them to be, right? So favorable means they
Faster.
completed their work in less time, right? So what are some things that would cause that?
Less coffee breaks.
Sure. Less coffee breaks, which means that's sometimes called work to rule. When the boss puts the hammer down and says, you guys stop sloughing off, we are going to be working 8 productive hours today and you can pee in 5 minutes, and that's it. No more pee time than that. So less coffee breaks. What are some other things that would make your workers complete their stuff in less time?
They're very skilled.
They're very skilled. What else?
They get bonuses or incentives to complete.
That's a really good one. Incentives. Because everybody knows that you do more work if you're going to get a bonus if you get finished. How many construction projects do they give bonuses if they finish that early, right? So let's say we've got a holiday coming up, May long weekend, but we've got a project that's due on the Tuesday after that, and we really want to get that done. Management wants to get that done. So, you know, let's say, okay, double time and a half for everybody that works overtime on a long weekend. They're going to work like dogs, right? So incentives, bonuses, there you go. So when you're thinking about what causes variances, usually we don't think about them in isolation, right? Like these are some things. So if we had, in our case, we had unfavorable rate variance and a favorable efficiency variance. Now let's say we've got two favorable variances. We've got a favorable labor variance and a favorable rate and. So if they're both favorable, does that eliminate any of these possibilities from what might have caused those? Could our workers still be paid less than standard time? Like underpaid? Yeah, if they were underpaid, would that affect the hours? No. No, that's still valid. What if they were less skilled? Right, because lower skilled workers get paid less? If they were less skilled, is it likely that we would have a favorable efficiency variance?
Unless there's
Not-
another,
Not likely.
very.
And unless there's another variable that would offset that. But in general, you wouldn't have these two things together, right? You wouldn't have this and this together. So when I'm asking you guys on the exam for reasons that you could explain, a certain variance combination, I want you to think. I don't want you to just give me this list, pick one, because you need to think about, is that likely or possible with this other variance, right? So just remember, you need to actually think about why things are being caused, because if your workers are being underpaid, that's a great problem to have unless they start quitting. So if you had an unfavorable, actually, there's another one. Let's say you had workers quit. Then you've got people doing a lot of work to compensate for the workers that are missing, right? Eventually you'll get burnout. So, you can't expect your workers to work 125% all the time without, easing up. So just keep that in mind. I should give you these solutions. Actually, you can grab them from me at the break, because we've got a lot to cover today, because there's only this class and next week, and then it's the exam. Yeah. Well, I was up till 2 in the morning doing my exam, writing my exam for you. What? I don't have a copy back yet. I will get one back from the department after she types it and Janine checks it. Okay, so last week we were in chapter 10, and we're going to start on page, actually I think what we'll do, to be honest, is I think we'll just quickly do, we started with problem 1020, and, right, we had calculated that stuff last week. Did we do 1020? No? Which one did I do? Oh, I used the review problem, didn't I?
Yeah.
Okay. Then I think what we'll do is we will start with, let's do problem 1020 on page 446. So we're just going to quickly do the direct material and direct labor variances. Oh, that's right, I did do that. Okay, so 446, it says, Clarissa McWhirter, blah, blah, blah. She's got a small variance on her income statement, and her company was having trouble in controlling manufacturing costs. So they give us a bunch of information in that standard cost card per unit. So those are per unit costs, right? So make sure that when we use those formulas, or if you want to use that format where you do your, basically this is your flexible budget. sorry, that's not what that is. This is the standard budget, which is standard amounts and standard costs. This is your flexible budget here, which is for the actual quantity produced. So you can use this too, but I personally get confused. So you won't see any solutions from me on that, but they have them in the textbook, and if that makes more sense to you, you always get the same answer. Okay, so the following information is available for the year that just completed, and they give you a bunch of actual stuff. Okay, so then they're telling you how to apply the overhead cost. So it's applied on the basis of standard direct labor hours. So they've told you, now you'll notice, and we haven't talked about the overhead costs, but we will later today. So we will just skip over D for now, and we'll do number 1 and number 2. So to compute the direct materials price and quantity variances for the year. So the first one, so this is problem 1020. So the first one is the direct material price variance. So we are interested in isolating the price. So when we hear price, that means we want to take the standard price from the actual price, right? So we paid what? The actual price, and we're going to take the standard price away from that. That's the real heart of this variance. And we're going to multiply that by what? Actual quantity. Okay, so we want to multiply that by that. So what is the actual quantity that we had in this question for materials? So we want to look 78,000. And there's an important piece in here, there were no beginning or ending inventory. So that means in this question, they used everything they purchased, okay? So they purchased 78,000 meters. And we're gonna multiply that by, so what was the actual price per meter? $3.75. And what was the standard price? Yeah, $3.50. So when we multiply that out, we're going to get 19.5 and oh well. Okay, so we get this number. So now, how do we decide if it's favorable or unfavorable? I'm sorry, I couldn't hear you.
Positive, so it's unfavorable?
Well, it's positive, so that means it's unfavorable. But rather than just trying to remember if positive or negative is unfavorable, because often people think if it's unfavorable, it's negative, and if it's positive, like that's just our natural inclination. So what I like to try to do is think if I spent more or less than I wanted to. So did I spend more or less? I spent more, so that makes this unfavorable. So you can think of it as positive, but you know, in a crunch you might forget which one was which. If I spent more, so that means that I have an unfavorable variance. So now we want to do the direct material quantity variance, which means we want to isolate how much over or under we used. right? We're interested in figuring out if we use too much or too little. So this is the guts of this one, right? So, man, these markers are crappy. Okay, so the quantity variance, if we're interested in isolating the quantity, then we want, just like actual less standard, we're going to do actual quantity minus standard quantity, right? And what are we going to multiply that against? The standard price. So Cheryl was mentioning that even though this is per unit, this is actually the big, huge quantity, and this is the big, like the total quantity, not just the quantity per unit, even though these are per unit prices, right? And the reason for that is because the difference is based on if you multiply too many of these, I'm going to have to figure out how to explain that. So at this point in time, we'll just leave it like that. This needs to be the huge quantity, right? We know that. So the actual quantity that we used for the direct material is what?
17,000.
It's what?
17,000.
Right. It's this thing right up here that we just used. So it's 78,000. And how much did we need to use? Or how much were we planning to use? Does it tell us what it is? Not straight out, right? So what do we need to grab from that standard cost card?
4 meters.
4 meters times, how many units?
22,000.
20,000 units, right. Because this is the actual quantity that we would need to make this many units. So that's 80,000, right? So here now we have minus 2,000 times, what's the standard price? It's up here, right? 350? So that gives us what? Yeah. So minus 7,000, and basically, when you give me a variance, I always want it positive, okay? So always give me a variance positive. Is it favorable or unfavorable? Favorable, because we used less, okay? So that's that. Now we're gonna do that.
Can I
What?
stop you for 1 second?
Yep.
I just don't know where you got the 7,000 from. Is that it?
I multiplied 3.5,
Yeah, I missed that.
which is the standard price,
Yep, yep, yep.
by the
Sorry.
difference here. That's okay.
I was
that gives
writing
me-
something and I totally didn't even see that under there, sorry.
That's okay. So that's where we get the 7,000. So what is the total direct material variance? 12.5, unfavorable, correct. Okay? So now let's do this for labor. So this will now be direct labor. That's not called the price variance anymore. What is it called when we're talking about labor? Rate. And what is this called when we're talking about labor? Efficiency. And to be honest with you, the names are not as important to me as the fact that you do the right things. So if you happened to call this the price variance for direct labor, I'd be fine if you do the question correct. Okay? Same thing with the efficiency variance, although the names are on the back. But again, it's not the key part of the question. So again here, instead of price, we're talking about rate, right? Other than that, the formulas are identical. Actual quantity times the actual rate minus the standard rate. So what is the actual quantity for direct labor? 32,500, correct. 32,500 direct labor hours. And what is the rate? The actual rate, what did we pay?
11.8 or something.
11.8, does it tell us that?
11 per hour.
Yep, so 11.8, and what was the standard? 12. So we thought we'd have to pay $12 an hour for our labor. So that gives us, that's 0.2 times 32.5, which is equal to 6,500. Now, is that favorable or unfavorable? Unfavorable because the actual rate is
Less.
less. So I paid less for my workers than I, okay, so I paid less for my workers. So this is a favorable variance. Okay, so then for the direct labor efficiency variance, so this is still the same, except instead of price, it says rate. So I know my standard rate is $12, right, for labor. Now the actual quantity that I used for labor, I think they told us was 32.5, right? So you shoot it up there, 32,500. What was the standard quantity?
30,000.
And how did you get that? Do I want to see 30,000 on your exam? Chances are not good. What do I want to see? 1.5 times 20,000 units, which is 30,000. So this is now 2,500 times 12 is 30,000. Thank you. And is this favorable or unfavorable? Sorry? Because I used more than I thought I should. So when we combine these two, I've got 30,000 unfavorable and 6,500 favorable, which means I have a total of, whatever the difference there. What? 23.5, sorry. 23.5 unfavorable. Okay. So now let's talk about overhead variances. So we're going to flip back to page 418, actually. Variable manufacturing overhead. You'll notice when you go through the textbook that overhead variances are split into variable and fixed variances, okay? Because you can't measure the same things. Oh, I'm sorry, were you not done? Actually, this is in the textbook, in the solutions for problem 1020, okay? So I've posted those online. So if you didn't write this down, it's right there. So we're going to continue with problem 1020 in a minute. Sorry about that. So variable manufacturing overhead variances are done very similarly to the way that we've just done those. And if you look at 418, they tell you that you basically take the actual hours at the actual rate. So the point that they're trying to make in this chapter about this is that overhead is applied or generated based on something, right? We've been talking about cost drivers, right? So they're basing, when they say actual hours, they're basing it on, that's the cost driver that they're talking about. So even though they call it the variable manufacturing overhead variances, when we're doing the efficiency variance, we're not actually measuring how efficiently the overhead was purchased or used or whatever. We're actually measuring the labor cost driver again. Because if our cost driver was really out of whack, if it wasn't similar to what we budgeted, because remember when we do our rate, how do we calculate the overhead rate that we apply?
Standard rates times actual.
No. Back when we were in chapter 3 and we wanted to apply overhead, remember variable manufacturing overhead?
On the website,
Actual goes here
and what the rate side.
and applied goes here. So how do we calculate the rate that we used for this? So the rate equals what? The estimated overhead, right? Divided by what? The estimated amount of the cost driver. So it's often direct labor. So let's assume for this it's direct labor. Okay, so we're going to assume direct labor is our cost driver. Okay, so we're going to come up with a rate based on that. So if we assume we're going to use that we're going to generate $500,000 of overhead, and we assume that we're going to have 100,000 hours of direct labor, then that gives us $5, right? But when we apply this, remember what happens if down here at the end of the year, we only made, let's say we made 20,000 units and we used 4 hours of labor for each unit, we only used 80,000 labor hours. That means we would apply $5. I don't know why I can't write it. I have really nice writing. I know you can't tell. $5 times 80,000 hours. That would give me $400,000 of overhead, right? But I've actually, let's say that my estimate is really good. And I actually incur $500,000. So what happens to this? What's the difference? I'm actually underapplied by 100,000, right? Underapplied. This is a variance, right? A variance is a difference, and I won't ask you to do this on the exam, so you don't need to. This is a variance. A variance is a measure of what you expected to use and what you did use. What costs you expected to have, what costs you actually had, right? So when you look at how this works, this is just basic math. This is called the denominator. Anything on the bottom part of a fraction is called the denominator, and the top is called the numerator. Forgive me if I sound simplistic. The reason I'm telling you that is because they refer to denominator activity in the textbook. So what they're trying to tell you is that because you're estimating based on an assumption that you're going to use a certain amount, it's going to cause a variance if you don't use the same amount that you estimate. But there's other ways that you can get a variance, right? So if you get this kind of a variance where the difference is because you had 2 different expectation and number, right? What happens if you actually did have 100,000? So let's say we did really we made 25,000 units, and so we did in fact incur 100,000 hours. But let's say that our actual costs, actual overhead, turned out to be 600,000. We are still going to have the exact same variance here. It's going to be 1,000 under applied, right? Because now we're going to have 100,000 times 5 is 500,000, but now our actual is 6. We still have a $100,000 variance, but now our variance is because of the top, this part. So the message they're trying to tell you is that your variance, so this variance is based on actual being more than this. So would this be what they would call a price variance or a efficiency variance? And basically an efficiency variance is when your amounts are different than what you estimated. So when the amounts are the same, that's not an efficiency variance. So the first one, when we had less, that was basically a variable manufacturing overhead efficiency variance. Let's look at how they calculate it in the textbook. They say that in this example here, the standard variable manufacturing overhead is $7.50 per unit. They got it by multiplying 2.5 hours per unit times $3 per hour. And they got the $3 per hour the same way I got 5 here, right? So that's theirs in this example on page 418, okay? So I'm going to erase my numbers, and we're going to look at the example that they have. Just keep it in mind when they're talking about denominators, they're talking about the cost driver itself. And my advice to you is, and I have a hard time doing this at work, I get into not a lot of trouble. I often go a little overtime on some of the files I'm working on because it drives me insane if I don't understand why these numbers need to be done like this. So I look at things, I'm like, okay, so the GST is here, and this is here, and this should feed into here, and I always analyze everything. And my boss likes to say to me, you would make a great chief, not such a good Indian, because I have to understand it. This is kind of the same way. If you find that you are just not understanding this material, if you can do the problem, don't worry about understanding it. Seriously, it's just, not worth hours of explanation or delving into the textbook. Try to do the problems, try to use the formula. If you can use the formula and get the right answer and you still don't get it, don't beat yourself up. So, I guess underlying all of that is, if I don't explain it well enough so you understand it, that's my problem. But I'll work on that. So anyway, they've calculated a rate of $7.50 an hour, okay? Then they have said that their actual variable manufacturing overhead was $15,390. You see it's in blue there? And so they took the lovely little square thing, or whatever you want to call those, the fence, and they've said that the actual hours of input times the actual rate is the one side of this equation, and the efficiency, which is the difference between that. So if you take, for our example, their actual overhead, so this is the spending variance is what they call this. It drives me nuts that they call these things different names. Like, realistically, this is the same thing as the price and the rate variance. So what they're doing is they're taking the actual hours and multiplying it by the actual rate and subtracting, which is exactly the same thing that we do for the other thing. So actual hours times, and I'm just squeezing it together like we do on the other ones. So actual hours times the actual rate minus the standard rate. So the way this looks is you take the actual hours, which is, where did they say what they were?
500.
Well, they're using 5,400. I'm just wondering where they got it from. They are going off of the, oh yeah, if you look on page 416, it says, oh, it refers back to 10-2. They told us quantity, labor, it says, blah, 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 blah. Oh, 5,400 hours of work. It says in the middle of page 416, during June, the company paid its direct labor workers $108,000 for 5,400 hours of work. So it's the exact same hours that you use to calculate the labor rate variance, because in reality, the overhead is applied based on that same cost driver, right? So don't get confused when you're doing these. This is the exact same number. So it's 5,400 in the example that we're doing. So in the question that we were doing over here, if our hours were 52 or 32.5, yeah, exactly. That's what we're using. We're not doing that question, but that's exactly right. So whoever said 32.5, yes. For question 10.2, that's the right number of hours. For the example that we're doing on the bottom of page 418, it's 5,400 hours. So now we've got the actual rate and the standard rate. So they've told you that the standard rate is $7.50 per unit of product. So that goes here. And then the actual rate, they probably tell you somewhere. That's the only thing I don't like. Oh, they've got $2.85 and $3. Oh, sorry, they're grabbing the rate from inside of the other thing. Ugh. You know what? Let's go back to problem 1020, because I think that's less confusing than bouncing around in this chapter. That's a simpler problem, but let's go back to 1020 on page 446, because we're familiar with those numbers. So, the spending variance is the actual hours. 446 is problem 1020. So it's the actual rate minus the standard rate. So oh, yeah. So you know how I had done the other thing where I said that we were applying the overhead, I took the whole overhead and I divided it by the amount, yeah, the amount of the cost driver, that gave us our rate. That's the same rate that we're talking about now. So in problem 1020, I just have to flip there. 446. So what is the standard? Okay, so if you look at the variable overhead on the standard unit cost card, it's got 1.5 direct labor hours at $2 per direct labor hour. So what is the rate that we want to use in there for our standard rate? From that.
$2.
Pardon?
$2.
$2, yeah. And what's our actual rate? Do we know that in this question? Let's see what they told us. Okay, so we're looking at D now. So when they say the denominator activity level in direct labor hours is 2,500, and the budgeted fixed overhead cost from the flexible budget is 150,000, and then they've got actual fixed overhead and actual variable overhead. So what we're going to do is we're going to take the actual hours. Do they break it down like that? They don't. Okay, so what they've done is they've taken the actual, so to get this number here, what they've actually done is, because they've given it to you in the question clumped together, they've given you the 68,250. But how can we figure out what the actual hours are that the overhead is based on?
Take the amount of overhead costs and divide them into.
Yeah,
actual
exactly.
hours.
So that would be the 68,250. Wait,
2.1.
sounds good to me. So I should have broken this out. So basically, the actual hours times the actual rate is this 68,250. That's what they're telling you. So the way that you get the actual hours is you take the 68,250 and you divide it by the actual rate.
Actual hours, 32,500. The actual hours at 32,500. And we get 2.1 for all actual rate.
Let's see. Do you guys end up with 32.5?
Yes.
And it's favorable or unfavorable? Perfect. Okay, so tell me what to write down here.
Actual hours,
Yeah.
so 32,500.
And you got that from the labor question, right?
Yep.
Where they said in C that the company worked 32,500. So this gives you this rate of 2.1, correct?
Yep. 2.1, yeah.
So this part is a bit trickier. So basically, this is the actual hours we use. I'm going to actually write this out bigger. So the actual hours are the same actual hours we use to calculate the labor efficiency and rate variances. And that's because the overhead is based on that cost driver. Because the variable overhead is based on direct labor hours. That's the cost driver. Okay? So therefore, when you do this question and you want to have actual hours times the actual rate minus the standard rate. The actual hours are those 32.5, which is what we used in the direct labor efficiency variance. So the standard rate we would get by the estimated overhead divided by the estimated direct labor hours, or the cost driver, which is this, right? So that means that the actual rate we would get by the actual overhead divided by the standard The reason that you use this is because that these are apples, right? Otherwise, you're combining the two pieces of your variance together. So this standard number of direct labor hours is the estimated direct labor hours, right? You're trying to figure out what the difference in the rate is, and this is your actual hours. So this comes to 2.1. And this is 2. And so that gives you, what was the answer then? Is that right? Yeah. And this is unfavorable because this is bigger. So the actual is bigger than, so if actual is more than expected, it's unfavorable.
Quick question. On the very bottom, it say AR equal actual MOH.
Yeah, actual overhead. This is estimated overhead, this is actual overhead, and these two pieces have to be the same. Otherwise, you're not making them something you can compare.
So it will be divided by actual hour on the bottom for AR.
Oh, you're right. Thank you. Apparently, I was a mistake. Ugh. I don't know how people write on these things. Must take practice.
Hours on the bottom.
There. Okay. You'll be happy to know that I'm probably not asking a question about variances, about this variance. Or my question will be more straightforward.
So we don't have to study this?
What's that?
So we don't have to study this?
So get rid of.
No, I would study it. I would be able, you should actually practice these kind of questions because they do help you understand what you're measuring. Because you still need to be able to explain to me how, like what it is you're measuring. I'll have to look at the exam. I'll tell you next week.
Can I ask you something regarding how you're calculating things?
Yeah.
On the video that you posted. with
Oh,
that
the
other
British
person-
guy?
Yes.
Yes.
He calculates them all using different formats than the textbook.
Oh,
You
what's
care?
his format?
He's doing it all differently based on he does the 3 steps, like with the, like for the variable overhead. He takes.
He actually does it more like this method.
Well, I found it much easier. I didn't think it was like that at all. Well, I
I-
guess he's using the same way, but he's not doing this minus that, well, he does at the end.
Yeah, he does.
I guess my
He's
point is
actually
if we
doing
follow-
these three things, and then he's telling you, these two things make this variance and these two make it. So he's
Yeah.
doing it this way. And if you find that simpler, you can calculate it this
Okay.
way.
That's what I wanted to know, because I found it much easier to follow the way he was explaining it.
Yeah, and that's
the format
what-
I used, and
yeah, yeah.
I find the textbook very confusing.
Did you get the same numbers? If you could do the problems and get the same numbers doing it his way, then you're fine.
Okay, I just wanted
Because
to
at
make
the
sure
end of the
that-
day, it'll all end up being the same numbers.
Okay.
So numbers never,
Well, I just wanted to make sure because you.
no,
like, the way
I
you do
posted
marking
those.
on tests and everything, you mark based on the format, and I just want to make sure if I'm.
I
doing
don't
it the way it
actually
said
do
on
that. I know I give it out with the marks allocated like that, but in general, what I do is most of the time people will do the questions the way I do them. But Jenny, for example, I told you did that question completely different than the way I had the solution, and she had like 3 or 4 lines written down, and I gave her full marks. In fact, I gave her a bonus mark because she had done it really elegantly. So I don't actually, I try to use that as a guide in most of the cases that happens, but at the end of the day, if I look at a question and I've given you more or less than I think that you actually showed me you knew that I asked for, then I try to mark that accordingly. So, yeah.
I just found it a lot easier to follow, so that's the way I did it. And that's the way I
Yeah,
did that
that's
question
fine.
assignment too, so if you look at it and wonder why it's.
Oh, that's
the way
fine,
I
too.
did it the way
Yep,
that
yep, yep.
he did it, because I found it much.
At the end of the day, if you can explain to me how to do something and you get to the right answer, I mean, that shows me you know what you're doing. You know, and the thing about numbers is there's often way more than one way to get an answer. And that's another reason why it's kind of tricky about the variances, because I can explain it one way. Somebody else will look at it in the textbook, it's slightly differently explained, but at the end it all kind of falls down into the same. And it doesn't help you when I didn't actually do this ahead of time. So, yeah, but I encourage you guys all to look at those videos if you're having any. Have you tried looking at those videos, Cheryl?
No.
You should actually. He's really, really good. He talks very slow and you think it's going to take you forever, but he's really clear.
And there's, as he's talking, like you can actually write all your notes as he's doing it, and he does it on a board and everything. It's
Yeah, he does it on a
easy to
whiteboard and he's
Way
very well spoken. I mean, I don't know if you noticed, but it's from the London School of Economics. Like, he's really a good prof. So let's try to do the efficiency variance. And so what the efficiency variance measures, as I mentioned, is not the efficiency of the overhead. It's actually what it's measuring is the cost driver. So the efficiency variance for the variable overhead is the same formula as the efficiency variable for labor rate. So variable overhead efficiency variance. Let's see if I can do this one right. Is the standard rate times the actual hours minus the standard hours. So the standard rate was $2, is that right? Yeah. So that's, oh, is that the standard rate for the overhead?
Variable overhead.
Okay, good.
Directly per hour.
Thank you. It's hard to bounce back and forth between questions. So I'm thinking, oh, is that from the other question? Okay, so now the actual hours, remember this is what we just used, that 32,500. And that was the actual hours from the labor rate, so therefore this is going to be the same thing, right? So how many hours would we, I mean, basically this is the exact same piece from the labor efficiency variance, right? So what did we use for the other part of that equation?
30,000.
Right. and that was 1.5 times, and again, if I've asked you to do this and you've gotten to 30,000, you could put 30,000 there, right? So we had done that, so we'll put 30,000, but again, if you haven't done that, you need to show me where you got that number from, because I'm not gonna guess for you. So that'll be $2 times 2,500, which is 5,000. So is this favorable or unfavorable? Unfavorable because we used more hours than we thought we would. So those are the two variable overheads. And then the fixed overhead is really simple. All you do, if you want to flip back to page 4, $422. Oh, is that still variable? Oh, here we are. 425 says the budget variance is the actual fixed overhead cost less the flexible budget fixed overhead cost. And if you look at Exhibit 1011, you can see in this example that they actually had 27.5 of fixed overhead, and that the flexible budget for fixed overhead was $25,000. So when you look at, where did they get that from? If you look on the bottom of page 422 at Exhibit 10.8, that shows you the flexible budget schedule. So you notice that the flexible budget numbers for the variable overhead costs, they all change, right, as you increase your activity. But if you look at the fixed overhead costs, they're identical for the flexible budget because they're fixed, right? And remember, fixed costs don't change with the units of production. So when you're calculating the budget variance, all you're calculating is the difference between what you spent and what you estimated you would spend. So that's just those two numbers subtracted from each other. And the fixed overhead, what is this one called? Volume variance, is just the difference between what was applied and what was the variable, right? Because when we talked about that $500,000 of overhead, there's going to be a variable portion of that, and there's going to be a fixed portion of that, right? But do we apply it the same way? When we created our rate that said that we were going to use 100,000 in direct labor hours, did we say whether these were fixed or variable costs? No. We generally just clump them together, come up with a rate, and that rate is actually a mixed cost. It has a mixed portion and a variable portion. So what they're saying is if you break those two pieces out and you still use the same rate, that the amount of overhead that you apply will be dependent on the number of direct labor hours or whatever your cost driver is that you used. But with fixed overhead, the entire difference is going to be based on the fact that you're applying fixed overhead based on units of production, and that's not how fixed overhead works. So that variance is called the volume variance, and that is how you calculate it. It's the difference between what you applied and what your fixed costs were. Okay? So to figure out how much you applied, you basically figure out what your fixed overhead rate is, and then you would get that number and then subtract it from what your actual fixeds were, and that's all there is to it. So you can be guaranteed, I won't ask you a question like this because this is trivial. Because there's nothing to it, right? Like, it's fixed.
Did you say you guarantee you would, or you guarantee?
Won't ask a question about fixed overhead variances. I will not ask a question about fixed overhead variances.
So it's keeping up with.
I'm just making sure that I'm recording for Jenny.
Oh,
Because she had surgery, herniated disc. Yeah. So, yes, so she asked me if I would tape lecture again. Okay, so that's overhead variances.
So are we skipping page 424?
Oh, sorry. Where are we? We're not skipping it, I just taught it to you. You can, however, use your judgment when you study
Okay.
and concentrate on more likely questions I will ask on the exam.
Sounds good.
So we didn't skip it.
you taught it in 5 seconds or less, come on.
That was at least a minute. Come on.
Sorry.
Okay, graphic analysis of fixed overhead variances on page 426. I'm not even going to talk about, so skip that. 426, yeah. So we've started today on 418. You need to know 418, 419. You need to know how to be able to do that. Okay? Then on 421, I talked about denominator activity, but I will look at the exam, but I'm pretty sure there's nothing about that. Computing an overhead rate, I did talk about that, so make sure you know. If you look in the middle of page 423 where it says the company can break its predetermined overhead rate into variable and fixed elements rather than using a single combined figure, and it shows you how they did that from the $9 per direct labor, you should know that, okay? And then we did page 424 and 425. You can skip graphical analysis of fixed overhead variances. Cautions in fixed overhead analysis is pretty obvious, so read it. Overhead variances and under and over applied costs. I basically just explained how they relate to each other. So if you didn't understand what I said, you can read it here in the textbook. But here it says on the top, the very first sentence on 428 says, the sum of the overhead variances equals the under or over applied overhead cost for a period. Okay, that makes sense, right? From what we just did. In the question that Joseph gave me, you calculated you showed me the journal entries for applying the overhead variances. I don't need you guys to know that for the exam. Okay? I don't know if it's in here, but just to clarify. Nice job. I don't need you to know that.
How about material or labor?
Pardon?
Material or labor variance?
You have to know that. That is on the exam. Guaranteed.
You mean for the journal entry?
No. The only journal entries that I want you to know were the ones that I tested on the midterm, which were for applying but I don't need you to know that for the variances. And I've already tested you twice on that, so the chances that I'll test you on that on the final are teeny, tiny, small, almost like non-existent. Don't study it. Did you catch that? Okay. Overhead reporting, variance investigations, and capacity analysis. On page 428. I have checkmarked the overhead performance report. it's actually good to know. So I wouldn't refer to it by this name, but no, you need to know how to be able to calculate the flexible budget variance. But no, you probably don't have to be able to produce this report specifically. Although it's very pretty. Okay, I better write down skip, so I remember. All right, on page 430, the bottom line is you guys should know how to calculate the variable overhead efficiency and rate variances, spending variance, but don't worry about the fixed overhead variances, okay? Variance investigation decisions. Okay, the important thing to know about that is there is a paragraph on page 431, it's about halfway down, that says, how should managers decide which variances are worth investigating? And it says one indicator is the dollar amount of the variance. A variance of $5 is probably not big enough to be worth spending any time on, whereas a variance of $5,000 might be worthwhile. But the bottom line to that is there is a concept in accounting called materiality. So if something is material, you don't need to know this for the exam, I just want to explain it to you. If something is material, that means it's a big enough number to make a difference to the person who's looking at the financial statements. So if I was trying to decide if I wanted to buy a stock and they had changed a number so that it was $10,000 less, if that company was Coca-Cola, the effect would be not even noticed on the financial statements because the company's way too big. If they had made a $20,000 error and the company was some grocery store down the road and I was looking at whether I wanted to buy that grocery store, that's a big number. Okay, so that's the concept of material, is whether it would make a difference. So the bottom line is if the variance is big enough, and usually they talk about percentages. One of the problems says, she was happy because the variance was under 3%. So often people will use a percentage. So the bottom line is they don't investigate every single variance, and you will be unlikely to get a question that asks you to explain that on the final. And then the paragraph under that starts talking about plotting variance data on a statistical control chart. I don't know if you recall, but I do not like those kind of charts. So skip that. Capacity analysis, you don't need to know that. And international use of standard costs, not testable. Evaluation of controls based on standard costs. I don't see anything worth testing in there. Read it at your leisure. Okay? That is the end of chapter 10. We need to move on to chapter 11, because next week we're going to do chapter 12, and there is a lot of good stuff in chapter 12 that I could easily see being tested. So, chapter 11, which is also a good meaty chapter. Chapter 11 has some good stuff. Okay, so I am pretty sure I posted the chapter 11 lecture notes. So you will note that we'll just flip through right now and talk about what we're going to test and what we're not going to test. Segment reporting, I love segment reporting. So we're definitely going to be talking about segment reporting on page 475, how you assign costs to segments, all of that, the breakdown of the traceable costs, we're going to talk about all of that. we're gonna talk about segment margins. On page 482, segment reporting for financial accounting, we're not gonna do that, so skip that piece. Hindrances to proper cost assignment, that's gonna be covered. Omission of costs, also important. Those other things there too, like I have actual red arrows under all of that. Hindrances to proper cost assignment, you should be aware of those. Make sure you read that section in case there's a concept question on something like that.
So all of that 42,
That
43?
hindrances to proper cost assignment that's on 42 and 43, yep. Then responsibility centers, yes. Transfer pricing is another really fond topic of mine, so we're gonna get into that in depth. Negotiated, all of that. All of this section until 492, when we hit evaluating investment center performance, all of that is going to be highly likely to be tested. Make sure you know how to do all of that. Return on investment, 492, you need to know how to do that. There's basically, I better make sure that those, hang on, I need to make a note to myself. If I ask you questions about that, the formulas from the top of page 494, ROI, margin, and turnover will be on the formula sheet. Although now that I think about it, I'm not sure if they are. So I will check. You should know what the criticisms of ROI are. That's on page 497. And residual income, which is really pretty easy. And so up to page 500, balanced scorecard. And we will discuss balanced scorecard right now. I know there's a way to pause this. I'm just trying to figure out what it is. Okay, so I'll talk about it here, and then I'll just tell Jen about it. So, but, since you need to take this for some other day, it's good if it's included. So it's included. Okay? Got that? Okay, good. So, I'll put a little note on the website, or talk among yourselves at break. So that's balanced scorecard, which goes from 500 to 507. And we will talk about cost of quality. And that stuff is also really interesting, to be honest. And that's the end of that chapter. So it's 10 after 8. Why don't we take a 10-minute break? And then I'm going to start lecturing at 20 after 8, whether you guys are back or not, because I got to get through this stuff by 9:30. Otherwise, I'll be bumping into chapter 12 next week. So 10 minutes, we'll start back at 20 after, and hopefully I can figure out how to pause this. Can't be that hard. Oh, I was wondering where that was. you have a question? I'm just trying to figure, I think I'll just turn it off.